collating and telling us about that. Now let's go to one of the stock which was buzzing yesterday, MAS Financial Services. Kamlesh Gandhi is now with us. The company has witnessed a sharp recovery in terms of disbursement and AUM growth. Company has anticipated a growth over the next 5 years to be in the range of 20 to 25% with a focus on loan growth, asset quality, profitability. What are the key drivers? Kamlesh, can you talk to us about the loan growth returning back to the pre-COVID levels?
Hi, yes, sir. Good morning. So, as shared with at various forums earlier, that we are witnessing a sharp recovery post-COVID or the normalization of activities, and that should put us back to a normal growth trajectory of around 20-25%, what we have maintained over all this decade or more than 2 decades, and accompanied by a very strong balance sheet and a very high quality of assets. We are very confident of regaining that growth trajectory of 20 to 25%. And in Q4 itself, we have demonstrated a growth of around 16 to 17% in AUM and profitability. And I think quarter on quarter, it should increase going forward. And even within this 2 months working, we have witnessed a very satisfactory activities at the ground level, be it on disbursement, be it on the asset quality. And we have a very comfortable liquidity position also. So accompanied by all these enablers, we are very confident that we'll be in a position to have a growth of anywhere between 20 to 25%.
Right. One of the worst hit sectors would be SME, MSME. How would you look at this space in terms of lending the way ahead?
So just to give you the ground level reality, MSME, SME was hit very badly during COVID. But that sector is equally picked up post-COVID, where there has been a distinct scenario where few of them are doing better than what they were. Few of them have maintained at the levels they were at pre-COVID, and few of them have really faced the existential crisis. So as far as our portfolio is concerned, given our given our fundamentals of extending credit where it is due, we could manage the portfolio stress at below 2% of our net stage 3 assets of the AUM. And that gives us the confidence to once again start the lending to this sector the way we were doing at the pre-COVID levels.
Interesting. Also tell me, you focus on quality coupled with normalization of liquidity as well. You also plan to foray into unsecured lending. Brief us a little bit about asset quality trends and what do you foresee going forward?
As far as asset quality stress is concerned, it is the function. I personally believe, being a practitioner for more than 2 decades, it's a function of how you design your products and what are your credit screens and how you adapt the fundamentals of extending credit where it is due. So given that background and our niche expertise of more than 2 decades, whatever products we enter into, whether it is secured, unsecured within the space of MSME, and we also are into wheels where it contributes around 10 to 15% of our AUM. We are more cautious and have demonstrated in the past that with a good credit underwriting practices, you can navigate through any of the crises successfully. So we are going to follow this dictum, and we are confident that going forward also we'll be in a position to maintain the quality of the assets. So at different times, you need to exercise different caution in terms of extending credit. And once that is done, I think it is good enough to navigate through any of the situation.
I must point out, and I'm sure your investors also must be, wary of that. The stock was up 7% yesterday. So good going on that, but it's still down 25% on a yearly basis. Wanted to understand what kind of a messaging would you like to give to your investors about, where the company sees value and, of course, the stock value as well.
See, I wish investor respects the fundamental that has been followed by the companies for more than 2 decades. If you analyze on any of the fundamentals, be it our capital adequacy of more than 20%, our track record of more than 25 years of demonstrating a 25% plus growth, navigating COVID with the highest quality standards and very high liquidity buffers, and once again coming back to normal, and our fundamental of prioritizing quality, profitability over just AUM growth. Because if I just share with you in a lending business, getting the AUM growth is the easiest thing to do. but you need to be courageous to be patient, and you need to be courageous to take the right decisions so as to extend credit where it is due and create value for all the stakeholders. So we have been doing this since last more than 2.5 decades, and I see no reason why investors should be worried about the future growth of the company. Whereby we also demonstrated the growth path from Q4 onwards. Having said that, the investors whom we interact very closely know that we are not a quarter-to-quarter company. Our medium-term view is a 10-year view. So mass is at a very strategic inflection point. And as I talked to you, if we grow at around any 20 to 25%, we are very strong enablers, and one of the strongest enabler being a self-propelling capital model. We raised capital in 2017, where we are close to around 3,200 crores in AUM. As I talked to you, we are close to 6,500 crores on a consolidated AUM, and that has grown only through internal accruals. So it has been a non-dilutive quality growth backed up by internal accruals and a demonstration of a very strong track record of very strong compounding story.
And what is the outlook, sir, when it comes to your net interest margins? You expect them to stabilize around 6.5% to 7% in the coming quarters?
Yeah, we foresee that to be at between 6.5% to 7% and maintain ROAs anywhere between 2.8% to 3.2%.
Thank you for taking time out and spelling out the outlook on your AUM growth, disbursements, your net interest margins, etc.